Hello, everybody. So we just got an announcement from the Treasury and from the Fed that both Silicon Valley Bank and Signature Bank deposit customers will be made whole. And in all of the videos that I made prior to this video, that's kind of what I was predicting / hoping for. By the way, we learned that Signature Bank was also closed on Sunday. So they're actually bailing out two banks. And we learned that the shareholders and the executives are wiped out as expected. So they're technically bailing out the customers of the bank, and we are not calling it a bailout because we want to be very careful with the language. But this is not a surprise because the Fed, to me, has always been bluffing. They have no choice but to resume QE. And to me, this is hidden QE, but this is an hidden way to resume QE because they're going to absorb the losses from the banks. So they create losses for banks by raising interest rates, and then once the system starts asking for deleveraging, once the system starts saying, "Hey, okay, Fed, let's go, let's deleverage," throws a big bankruptcy at you, the Fed says, "Oh no, now's the right time. Forget about it. No. We need Silicon Valley Bank. Now's not the right time to do a deleveraging. Sorry," and they start QE again. And this is what has happened today, no doubt in my mind. And as expected, they announced that right before the Asian Open. Right, actually, Silicon Valley Bank had a lot of business with China. So they announced that right before Asia, and this unfolded exactly like the movie Too Big to Fail. Like if you look at the movie Too Big to Fail and how they let Lehman fail and all of the issues that ensued, they did everything so that the Lehman situation would not happen again. And this is so similar to this movie, down to them announcing before Asia opens, which I think is very interesting. The whole playbook is in here. I believe it's QE to infinity. To me, this is an hidden way to do QE, and I'll explain in just a second here. Let me just go through the announcement first. So first of all, what's the statement? Well, there's a bunch of blah blah right here, but essentially everybody's been made whole. They have the usual political stuff like saying there will not be a burden on the taxpayer, etc. Saying that the executives won't get anything, etc., but that the customers are made whole. That's fine. That's usual speak. But there's two important things as far as I'm concerned. The first important thing is that Silicon Valley Bank and Signature Bank, as we just learned today, are getting bailed out. Their customers are getting bailed out. Equity is getting wiped out. Execs are getting wiped out, but the customers are getting bailed out. And they are getting bailed out with the FDIC funds, right? And so you can see they've been accumulating these funds for 15 years. Those funds were supposed to insure you up to $250,000. That's gone out of the window. Now those funds insure you entirely. So whether you're Roku, Roku had $500 million with Silicon Valley Bank. So Roku's going to get $500 million from that fund alone. Think about that. Roku alone is getting $500 million from that fund. So so they're going to pay for everything. So that's kind of a major shift here. And I do not know the size of the whole across both banks. I do not know how many assets they have. CNBC was talking about 152 billion, but that was in the heat of the crisis. So I'm sure there's better estimates right now. All I'll say is that it would not surprise me if the whole was 100 billion. So you can imagine if they get 100 billion out of this, they will get back to 2008, 2009 levels. And so what that means is that they are going to replenish that FDIC fund. And so they felt the need to include in that announcement that there will be a special assessment on banks to socialize these losses, which is essentially what has happened. And so, of course, that special assessment, i.e. how much more these banks are going to pay in the FDIC to pay for the bailout of SIVB, what do you think banks are going to do, right? Banks are going to charge that on consumers, or they are going to borrow it, which increases inflation, which is a hidden tax on the consumer. So who's paying for this? Well, unless you don't consume anything and you don't buy a bank account you are paying for this. So when they say the taxpayer is not paying for this, that is not true, because most taxpayers are also bank account holders. And if you own a bank account, the FDIC fees are going to increase on your bank, which is going to pass those expenses to you. So they're just playing with words. But it's the same thing over and over again. It's all about, socializing the losses, which is exactly what has happened here. Not surprising, right? This is where it gets, though, more interesting into when I say QE is back, money printing is back. They'll never admit it. They'll never call it forward. We may actually get another interest rate hike. I think it will be tiny. It will not be 50 basis points. I think it's going to be 25. But this kind of allows them to go on maybe until May with the rate hikes, because this is all a hidden thing. So what they did is they created this bank term funding program, which allows access to $25 billion of credit protection for all of the Federal Reserve banks, the commercial banks that are connected to the Federal Reserve Bank. So essentially, all of the financial institutions in the US are eligible to participate in this $25 billion program. Now, I call this hidden money printing because it's $25 billion to start. It's the Treasury who's handling it. And of course, we know that the US government has a $1 trillion deficit. So this will just add to the deficit, which then in turn will be funded by base money, i.e. money printing from the Fed. So the Fed will have to print more money to buy more treasuries, and a share of those treasuries that are going to be issued are going to be used to fund this extra program, which, they don't have the money to fund anyways. So you're just kicking the can down the road. Money problems are solved with more money, and they just create more money. But it's convoluted, right? It's hidden because, this is the Fed will be the buyer of last resort of treasuries. So you have to go through at least 2 degrees of freedom to understand that it's the Fed that's doing this, right? But it is the Fed that's doing this. Anyways, what are some of the terms? So you're going to see how wonderful these terms are. This is wonderful for the banks. There is no consequences for risky behavior. So what is it? So imagine you have mortgage-backed securities, and I took realistic numbers here. I extrapolated from the SVB situation. So imagine you bought $10 billion of MBS in late 2020, early 2021. They're now worth only $8 billion. And keep in mind, this is done over $1 trillion plus, right, across all of the banks. This is not just $10 billion. And let's assume you have your consumers that do their cash spend as usual or spend more money, and the customers want to spend the money. So customers want their money, right? Your depositors, right? You owe them money. And in the normal situation, what happened to SVB is they had to sell their MBS at a loss to give money to the customers. Now it's done, right? With a bank term funding program, if you have your customers that want money out of the bank, you don't sell at a loss anymore. They're going to be able to pledge their mortgage-backed security to the bank term funding program at a $10 billion par value, not an $8 billion fair value. So that unrealized loss, that concept is entirely gone, because you're going to be able to place the loan on a pre-loss basis, right? It's kind of like if you have a loss on a stock, you can pledge the stock to, say, a bank and borrow on margin on the stock that you initially bought the stock at. So imagine if you buy a stock that's down like 90%. And you can still yield it at 10x more than it's worth. So it's not about fair value accounting anymore. It's about just what you paid for it. So the Fed is financing your mistakes here effectively. And where it gets so much better, and you're increasing leverage. So imagine you have a bond that's only worth like 75% of what it used to be worth. You can pledge it at 100% of what it used to be worth, so you have a delta of 25% extra, but you also do it at 100%. That's like 100% margin, and you get charged the cheapest interest rate, essentially in the history of interest rate, which is the overnight swap rate plus 10 basis point or 0.1%. So you get charged the cheapest of the cheapest interest rates. Furthermore, as a private individual or as a company, right, with your broker, if you were to want to do margin, there would be fees. There are no fees. And they are telling us that the program is available until at least March 2024. And they went out of their way to include at least in the publication, right? So you're going to go out of your way to include at least. This is very dovish language, right? This is not a firm date. This is at least until 2024. So that thing is never going to go away. That's my opinion. Conclusion, what? Now that this is in place, right, it's going to be very easy for anybody to, A, extend the date past March 2024, and B, expand that $25 billion limit, right? It wouldn't even make the news. And they're going to have to expand that limit because there's more than $600 billion of unrealized losses out there. So it's going to be so easy. They're just going to change it, and it won't even make the headline on CNBC, I don't even think. Right now that they've done this, now they used emergency as an excuse to do this. Now that this is done, the whole banking system is as kind of a backdoor for monetary printing. This is a backdoor monetary printing. That's all it is in my view. And so, like I said, my thoughts is new base money is going to solve your money problems. Money problems brought about by the Fed are going to be solved by the Fed through convoluted money printing, going through the purchase of treasuries, which are then used to buy at par mortgage-backed securities that are not worth nearly as much as they used to be. So it's kind of a loop. The Fed tightens rates on one hand to hurt the banks. Because the Fed has hurt the banks, created a lot of losses in the banks, the Treasury starts a program to erase those losses for the banks. Right, because it's going to be rolled over and rolled over and rolled over, because I do not believe that March 2024 is when it's going to end. I don't think it's going to end. And then the Fed creates new base money in order to fund the government deficit, some of which is used to fund the Treasury, which funds the losses for the banks. So it's a loop. It's kind of an endless loop. This is Michael Burry. He's kind of an expert on this. He's comparing 2023. It's always the same thing, People take mistakes, and nobody wants to pay for it, right? Nobody wants to pay for it. And therefore, since nobody wants to pay for it, the money has to be printed. And generations don't want to pay for it. If we were to enter a depression, which is what we're due for per the debt cycle theory, everybody would suffer in a depression. A depression is a silent generation. There is no desire in the world for a world depression. That's just not the case anymore. I'm not even sure they wanted it. They clearly probably didn't want it, and if they could have avoided it, they probably would have avoided it in the 30s. There's just no desire, and so that's why these theories, this Keynesian economics, all of that kind of stuff is so popular because nobody's willing to go through the pain to save the US dollar. So that's why I say, in my view, right, I named the channel after this, Denominator, i.e. the money stock. Everything divided by the money stock is ever growing. Quantitative easing to infinity, in my view, is the surest thing that we can have in macro, right? That's why my portfolio is 1/3 hard asset, like Bitcoin, another third real estate, and the last third is hyper-growth stocks. Why hyper-growth stocks? Because I believe these are the only stocks that can beat debasement. If your company does not take in more 15% more dollars each year, you're falling behind. The money stock is growing faster than how much money you're taking in. Companies need to take in more dollars each year than the growth of the money stock. So that's why I believe hyper-growth stocks and hard assets are kind of only valid ways, in my view, no investment advice, but in my view, the only valid ways to beat this monetary inflation, which, they've created a backdoor. And let me explain to you again further why they've created a backdoor here. So all banks now are going to have an incentive to erase these losses. Right? If you have unrealized losses sitting on the book, and your customers want their money to live, for their spending expenses or whatever reason, you're very, very likely to use that program. Nobody's going to sell now. You would be a fool if you sold for loss your mortgage-backed securities. Well, you can just pledge them to the Fed, who's going to give you what you lost on margin at the lowest interest rate possible. Right, so the debt snowball just continues, and if you look at U.S. banks, right now they're sitting on 620 billion of unrealized losses. And actually, I've been reading about this on Twitter. A lot of people on Twitter seem to come with estimates that it's actually more like $1 trillion in unrealized losses. So, anyways, this is pretty crazy, right? So it's like you've reduced, like the Fed has reduced money supply. If you look M2, they've moved from almost 22 trillion to like 21.3 trillion of M2. So what they've reduced money supply by through all of the pain that we've had over the past 18 months, banks are about to print it back because of that program. because they have $620 billion in unrealized losses, and now they don't have to realize these losses because they can redeem at par value those bonds. And so, it's why when I hear the $25 billion for that program, right? When I hear until March 2024 for that program, that makes me laugh because, of course, and the market knows this, and we'll see this tomorrow because I know the market, the futures are positive, but the market is probably going to skyrocket, in my view. Because we know that nothing is temporary in government. Like, once you give something, like now that they've given this to the bank, it's going to be very, very, very hard to take it back. Like, how do you see yourself removing this if you have a bunch of quote-unquote zombie banks that are only surviving because of this? Do we really think they're going to remove this? Do we really think if they reach the $25 billion soon, and I think they will reach it much sooner than most think, do we really think that they're not going to raise it? They're going to raise it. I don't even think it will make the news except in the finance community. So when governments put programs that are so beneficial in place, it's very hard to remove. And if you look there's a flurry of old government programs that are still here, deferred action for childhood arrivals. How long has that been around? Like 15 years? Student loan deferrals. 3 years, right? And you still have essentially a bailout of student loans for the past 3 years where you don't even make payments, right? Stimulus checks. If you remember the stimulus checks, you were supposed to have just one. How many did they do? I wasn't getting them, so I don't know how much they did, but I know they did more than one. Probably I think they did 5 or something. Buyback tax, right? Buyback tax. It was just supposed to be 1%. Now they want to actively raise it to 4%. Once government programs are in place, they are very, very hard to remove, and they typically grow and expand, right? Administration expands. So that's why I believe the market is so positive. That's why, that's why I believe I'm very confident about my view, my informed view that QE to infinity is the way that it's going to be for the foreseeable future, and I think for my lifetime. That's what I think. Whether it's 2001, you may remember war and terror, all of that stuff. 2008, right, the banks going bankrupt. 2020, right, small business, restaurants shutting down. Or 2023, tech and tech startups shutting down. There's always a good reason to not have a deleveraging. Not small businesses, not tech startup, not AIG. And the banks and the auto, right? Oh no, we have to. There's always a good reason. There's always a good reason to not enter a deleveraging right now. There's always a good reason to not enter a 20 to 25 year period where we collectively decide to pay our debt and essentially live in misery. Nobody in modern society, nobody wants to do that anymore. Nobody would tolerate a depression anymore. Right? We would not tolerate a lost generation anymore. And because of that, we have collectively decided, subconsciously probably, but we've collectively decided that we're just going to increase the money stock to infinity, right? The last time we had the deleveraging was the 1930s, and I believe ever since we have decided to increase the money stock to infinity. Hence my channel. That's what my channel exists. This is the state of affairs. This is one of my very first video that I introduced the channel is I was talking about how I came up to, the money stock was growing 11 to 12% a year for perhaps a decade, ever since 2008. And I believe ever since 2020, right, we've entered an era where money stock is growing at 15% a year, i.e., if you're not getting a 15% raise each year at your job, if your investments are not going up by 15% each year, you're falling behind because your share of the wealth, your share of the world's wealth is entirely getting diluted, right? You're getting diluted, and you don't want to be diluted. And don't forget, this is also another problem. The euro dollars, whenever I see this analysis, I see a lot of people just quoting M2. The problem is that there's euro dollars, right? Or what they call hidden debt, or non-US banks who also issue debt. And this may be up to $65 trillion. So actually even more than what I was anticipating here. So again, money gets diluted, and this is the state of affairs. And all of those unrealized losses are not going to be realized because those unrealized losses on MBS are going to be pledged to the Fed, who's going to give the money to the bank at par for one of the cheapest interest rates around. So that's just the way it is. I'll conclude with this. That's the current state of affairs, right? 1933, the depth of the Great Depression, a house, big house like this, was $1,700. Okay, you had to pay labor and you had to pay for land. So round it up to 2,200 or 2,300. Today, that same house used is about $400,000. Exactly the same house. That's a Sears home. I love Sears catalogs. Get a hold. If you ever want to understand the value of money, buy an old Sears catalog, and they're fascinating. And that's why people who are well aware of this fiat system and very knowledgeable about the fiat system tell us, and don't lie to us, right? They tell us very clearly almost any currency will be worthless within 100 years. That is because we're never willing to deleverage. We're never willing to reduce the amount of money stock out there because money is debt, and we're never willing to reduce that money stock. So anyways, this is the conclusion of this video. The banks are safe. This is as predicted. I'm very stoic about the situation. I'm not making any value judgment. In fact, personally, philosophically, I would be against wrong incentives like a bailout. I would be against that. But as an investor, I think what's important is more to observe how the world is, rather than have an opinion. Online you see plenty of opinions. We shouldn't do that. We shouldn't do that. We shouldn't do that. Well, you're acting as a voter when you say we shouldn't do that. As an investor, I think you should just try to predict, try to think about what's going to happen. I don't like the fact that this dilution happens, but there's very little things you can do about it, and so I think as an investor you just have to be stoic and look at it, and it was obvious to me that they were going to bail them out, even though they don't call it a bailout, they call it a customer deposit safety, whatever they call it. But yeah, I think this will put a major dent into the quantitative tightening plans of the Fed. Jay Powell may get away with one more rate hike or two more rate hikes, but they've just created a backdoor where banks are going to have a much harder time collapsing now that there is that backdoor where they can just redeem their old investments at par. I mean, imagine if you had a way to redeem your stocks. You probably own stocks if you watch this channel. Imagine if you had a way to redeem your stocks at the price you bought them, right? Would you take that opportunity? Probably. So anyways, this is not investment advice. This is just entertainment. I hope you were entertained. Thank you for watching. Appreciate your likes and your subscribes. Have a great day.